The goals of experimentation is to avoid correlation. We need strong causation, strong causality between the cause and an effect with very high confidence and very low likelihood of making a business error, which is you don't want to have false positives, you don't want to have false negatives.
Hello and welcome to Experimentation Masters, the leading resource for business experimentation. Join fellow innovators, strategists, and entrepreneurs to learn practical tips, methods, and techniques from world-leading experts in experimentation. Design better experiments, lead with more confidence, and have greater impact in your organization. Now please welcome your host, Gavin Bryant.
Hello and welcome to the Experimentation Masters podcast. Today, I would like to welcome Vishal Kapoor to the show. Vishal is Director of Product at Shipt, a high-growth delivery marketplace that facilitates same-day grocery deliveries. More than 300,000 Shipt shoppers deliver customer orders across the United States, with Shipt valued at $15 billion with revenues of more than $1 billion per annum. Prior to Shipt, Vishal was lead product manager, marketplace pricing and intelligence at Lyft, and also led growth of Words with Friends at Zynga. Vishal has also held roles at Amazon, Microsoft, and Yahoo. In this episode, we're going to discuss marketplace experimentation from 0 to 1. Welcome to the show, Vishal.
Thanks, Gavin. I'm very excited to be here.
Now, a little bit of preamble for our audience. In this episode of the podcast, I'm going to try something a little bit different. This episode will feel more like a hybrid podcast/webinar. So think of it as an experiment on the Experimentation Masters podcast, if you like. As always, I welcome your feedback on any of the episodes. We felt that this format would maximize value for the audience better as we'll be stepping through a practical experimentation scenario today. Vishal has kindly prepared some slides to accompany our discussion. To access the slides, head over to the First Principles website at firstprinciples.ventures, then podcast and Vishal Kapoor episode. I'll also be posting this episode on YouTube. You can access the episode on the First Principles Experimentation channel. Vishal, over to you.
Thank you so much. Again, thanks for having me. Let me start sharing my screen, and then we can take it from there. Can you see my screen, Gavin?
Okay, I've got it.
Sounds great. So once again, thanks for having me. Before we get into the podcast and the content itself, I wanted to just give a quick introduction of why are we talking about marketplace experimentation from 0 to 1. This is my second attempt at such a topic. There is another topic that I have spoken to in that I've given public discourses on, which is called Surge Pricing 0 to 1. So at my company, I am responsible for products that actually price our offers, price the orders that are coming in for our shoppers. Shipt is, by way of introduction, Shipt is a three-sided marketplace, a grocery delivery marketplace where customers are placing the orders. The orders are being shopped from a retailer or a grocery store. And finally, the shoppers are the ones who are actually fulfilling the orders. So a big part of that marketplace of clearing the orders or having the orders fulfilled is how do we price the orders? So one series of talk that I've given before is one topic is on surge pricing 0 to 1. How do you build a surge pricing, a dynamic pricing system in a real-time marketplace? This is the second in the series. It's called Marketplace Experimentation from 0 to 1. And I hope to, continue giving such kind of talks in the future as well. So thanks for having me, Gavin. All right. So quickly, just to introduce myself, Gavin, thanks again for recapping. I am currently a director of product at Shipt. I am an engineer turned product manager. with my pedigree in different technology companies, large and small. I have spoken at different public forums, such as Microsoft, Carnegie Mellon, few conferences. And my LinkedIn is up there for anybody who wants to connect with me and ask me any questions. Follow an open door, open LinkedIn policy. So please connect with me. Feel free to ask me any questions after. All right. So loosely, this is what we are going to run through today. It's a lot, but what my goal behind this talk is to cover is, as Gavin mentioned, walk through a practical example of what a company might be trying to do and explore different techniques, different ways of looking at data, running an experiment, what kind of different avenues do we have available. And these are some of the techniques that are used at some of the best tech companies in the world today. So what are some of these techniques available? We will start about talking about why even talk about marketplace experimentation. What's the point? We will talk about what are the goals of a business or a company doing experimentation? What are the business goals behind having an experimentation mindset? We're going to talk about some practical challenges and constraints, specifically when you talk about experimenting for marketplaces versus other scenarios. Then we will go into a test scenario. We'll talk about different testing and analysis techniques. We'll go through it as we go through the deck. Finally, we will talk about what is the difference between what we call as an experiment or a test versus an optimization system. And what are some of the techniques that we use for optimization versus testing. And then finally, I will leave you guys with some final thoughts and key takeaways of what should you take away from this entire deck? What should you walk away with if you are looking to experiment in marketplaces? All right, so let's start with why give a talk about experimentation in the first place. So testing and experimentation today is the primary technique for either growing a business or deepening the business, meaning, improving your top line of how users come in, how they stick, how many users, how they experience the product, as well as making them stick longer and longer and longer, improving your engagement. This is the way in which, you may have heard of, roles in product, for example, growth product manager or revenue product manager, or, these kind of, or ads product manager. The primary skill set that a lot of these PMs use, including the PMs, including me, I learned this, as I moved over from engineering to being a PM. The primary thing that I learned, the most important skill set that I learned was to run experiments, how to experiment, how to think critically and analytically about different ideas and to grow the business. It is a critical skill to master for technologists, but unfortunately, it remains somewhat arcane, and it remains limited only to people who have skills in math or computer science or statistics. My goal here is to demystify marketplace experimentation and make it more accessible to broader audiences, to more non-technical audiences. I don't have a lot of math in the deck. It's more about walking through a very, very practical, lucid example and walking through what are the pitfalls of doing this versus that. How should you think about experimentation, from somebody who's not a mathematician or a computer scientist or a statistician, for example. So really for business leaders, for business managers, that's where the topic we're in.
Vishal, I've got a couple of quick questions at this point. First one, philosophically, I've previously heard you suggest that PMs need to be more like a hunter than a farmer. Could you explain to the audience about that, please?
Yeah. I've been, multiple people have taken that quote, and have asked me about it. I think one part is, so I think where that comes from is, for me, uh, hunting is a skill where you are able to find diamonds in a coal mine, right? You're able to go and find jewels in the rough. You're able to go and see there is a there are a lot of different things you need to do as a product manager to actually make a product ship. There's so many things that you need to do. You have to be able to, not only just build the product, not only just communicate what you are trying to build, but make sure that it works fine. Make sure that you are, communicating outside with your audience. You're managing the change in the marketplace. You work with your communications teams. You work with your finance teams. You work with any legal challenges. There are so many things that a product manager needs to do to actually get something done. But when I mean that, don't be a farmer and be a hunter, for me, it really starts from what is the idea that you're going after, right? Which is try to find and try to come up with a good justification of why should you, and come up with a data-driven justification, really, or why should you try to do A versus B? Because there is always an opportunity cost. If you did not do B, and if you chose to do A, there is always a time opportunity cost, right? Because you don't get that time back. Time is one fixed commodity for everybody in their life. So why should you think about this versus that? And I think that's a good question, Gavin, because this experimentation is really the way to quickly validate. Sometimes you don't have data. Sometimes you don't have a strong hypothesis. Sometimes you don't have intuition on whether it should be A versus B. And the real goal of experimentation, at least in big tech companies, is to really just do that and find that very quickly in a couple of weeks. Generally, that's what you're trying to do. And as you will see, a lot of tech companies, what they'll do is they do very incremental product updates, very, very incremental launches. I was reading a book yesterday about OKRs and about how OKRs were implemented at Google. There's a famous book called Measure What Matters by John Doerr. And there they talked about how they made YouTube as, they had a North Star at YouTube, which is 1 billion views per day, which at that time seemed very, very like a big moonshot when YouTube was coming up. And they talk about how they surgically did experiment after experiment after experiment after experiment. Little things like, does the like button work? Like, should we, what content should we recommend after one video? Should we recommend anything? All of these things, little things, are experiments, small scale experiments. You try very quickly, really, really fast. You make a confident justification whether A works versus B. And then you decide to launch it. It's a decision-making framework, essentially. You decide to launch A versus decide to launch B. So in that context, the question that you asked, that is what I think is a critical skill for hunting. One thing is you need to be analytical to size a problem. But second is if you don't know how to do it, you need to be able to experiment to find out how can you quickly get some data, run a small-scale test, get some data to be able to say whether A is better than B.
So the good PMs, the skilled PMs, they're very good at identifying opportunities, innovations, customer problems to solve, and then performing experiments to support their product intuition.
Exactly right. That's exactly right. Either you know the problem. Usually it starts with intuition because you work on a product and you are intimately familiar with what the product does. You start with a feeling, but many, many times we come upon ideas even internally at the company where it's not clear whether it will go one way or the other. So then let's test it, right? Let's launch a small scale test. Let's find out a very, very surgical, what is the key idea we are trying to test? Just focus on that one idea, run it for 2 weeks, run it for a couple of weeks, get some data. And we will look at some of the techniques that we use actually in this deck. And that's how we make decisions.
Do you think that with product intuition, that if we're not performing experiments constantly to update our mental models and our intuition, that gaps then become evident in our product intuition? Have you experienced that?
Unfortunately, yes. I would answer that in 2 ways, right? One way is that I would answer that in 2 ways. Sometimes, especially for very, very fledgling companies, very, very small companies, where you're really trying to find product market fit. You have a product, you've just launched it. I would even call that whole experience of finding product market fit as one big experiment, if you will. Either it works or it doesn't, right? And it's, it fails or it doesn't. But there are sometimes there are cases where you just cannot experiment. For example, if you came up with with an idea, and this is something called a split test, which is also technically it's called a test, but but it's not technically an experiment. Where, let's say, if you were completely revamping your app with a new version of the app, now you wouldn't truly know. You could test some things that go into that app into the old app, but you wouldn't truly know how people are perceiving the new app until the rubber hits the road, right? So there are some things where you have to really just try it and launch it and see where, at scale, basically what happens. But most of the time, that's those cases are very, very rare. Most of the times what you do is you are able to make incremental changes to come to these decisions incrementally, and then combine all the decisions into one launch, and then, launch that. So I would say, yes, I would say that unfortunately in companies, there are companies, I've been in companies, and I think one of your previous talks talked about this as well. Not every company has the culture of experimentation. But I can tell you from experience that the companies that have a culture of experimentation are leaps and bounds ahead of the companies that do not, because there is no subjectivity. Everybody's aligned. It's not just the culture of experimentation, it's the culture of being rooted in data and making confident decisions, confident business decisions based on data, not making false positive decisions when you see something that is not reliable, not making false negative decisions. If something says no, but it's not true, not making a business decision on that and staying your course. These things only come when you develop some level of experimentation at the company, in my opinion.
Thanks, Vishal.
Yeah. Awesome. So these are great. I'll keep going. We'll cover some of these, Gavin, as we mentioned, as we go. And that's a great segue into this. Why experiment? Why does a business care about experimentation, right? I mean, anything is costly. It's a skill. And building a skill is costly and it takes time and all of that. So why even bother? We will actually start with, let's get down to some definitions here to kind of, start bringing this data oriented, what does it mean to actually experiment? So really what you're trying to do as a business, right? You're trying to, when you launch something, you want to measure causal inference. What that means is, I did this, I launched, a feature was launched, therefore this happened. Right? We launched this, therefore our users increased, or we reduced price, therefore our sales went up, or something else. Like, we did this, therefore that happened. That decision making, the cause is what led to the effect, is actually not a very, very easy decision. It's not very easy to actually draw. If you go down, and we'll look at that as we go, it's not a very straight line to draw in many, many scenarios. So let's start there. Let's talk about, what does a business really want? So first of all, let's define causal inference. Causal inference means simply some action was taken, some action A was taken, and there was an effect B because of that action. So A causes B. Now, let's take a simple example from the real world. If someone plays the piano, I will hear music. Let's say, I'm in the same room and somebody's playing the piano, I hear the music. That's a straight cause and effect. One of the pitfalls that happens as a business is that sometimes people mistake correlation with causation, which means that something has happened, but that doesn't necessarily mean, that means B happened, an effect happened, but maybe that was because of A. That doesn't mean it was definitively because of A. And that is something that businesses want to avoid. Our users increased, but did they increase because of a change we made? Or was that something else externally that happened? Maybe our competitor pulled out of the marketplace. Maybe that's why the users had nobody else to go. So therefore they increased. These kind of things, like how do you actually unbias yourself, is something that is a big pitfall that happens in business decision making. So let's continue our example. If I am hearing music, maybe or may not be, somebody may or may not be playing the piano. Maybe. I mean, it doesn't always mean, right? Like our cause is somebody's playing the piano. Our effect is I'm hearing music. I may be hearing music because, I'm hearing it from, off of YouTube, for example, off my computer. That doesn't mean somebody's playing the piano. So that's what I mean by correlation is not causation. The other problems that also happen in decision making is you want to avoid false positives, which means that the effect happened because of it. So here, for example, if I'm hearing music, someone must be playing the piano. That's also not true, right? I may be, again, as I said, I may be hearing music because of other reasons. It doesn't mean somebody has to play the piano. I could be doing it because of something else. That's a false positive, which is I am seeing the effect, therefore that cause must be true. That is a false positive. And finally, a false negative. I'm hearing music, but nobody's playing the piano, which is B, but not A. Which truly means that, a false negative really is that I'm not hearing music, but that means that, nobody's playing the piano. I think I need to revise that. I think I have a typo there. I'm not hearing music, but no one is playing the piano. But that's also not true. I may not be in the same room where somebody's playing the piano. Therefore, I'm not hearing music. I may be outside. I may be in a different room. That's a false negative. Always assuming that I'm not seeing an effect is in the absence of a cause. That's basically a false negative. And we'll see some of these as we go. So, there's a small typo. It should say I'm not hearing music, but no one is playing the piano. That's a false negative. All right. So what? Go on. Sorry.
So in your experience with product teams, do you think that when product teams mistake correlation for causation, they hear music, but there's no one playing the piano? Is that one of the biggest mistakes?
That is a fairly common mistake. And I will use another term for that. There's a term called confirmation bias, which is you see what you want to see, regardless of what the data is telling you. And that usually is an indicator that you are trying to find correlation in data where there is no strict causality. That confirmation bias is an outcome of the fact that you can see A leads to B, but you don't know if A has strictly caused B. You don't know that. That happens fairly often. Yeah, it does.
All music is associated with being a piano.
Exactly right. That's not always true. That's just not always true. That's right. So what are we trying to do as business leaders, right? And when we run a business, the goals of experimentation is to avoid correlation. We need strong causation, strong causality between the cause and an effect with very high confidence and very low likelihood of making a business error, which is you don't want to have false positives, you don't want to have false negatives. Right? That's essentially the goal. We want to have strong causality. We want to have high confidence that the causality is strong. We launched something, therefore an effect happened. We reduce prices, therefore our sales went up. And it's not always easy. As coming back to what you were saying, right? Our sales went up is not always because we actually dropped prices. It could be because our competitors went out of business. Therefore, our sales went up. There could be so many other things. And that is the key behind building a business statistically sound principles, on experimentation principles. How do we know when we did an action that there was an effect because of the action we took? Removing all the other biases that happen outside. That's really the goal. Wonderful. Okay. So now let's talk about some of the practical challenges and constraints in building a business. Let's again take it one level down. I promise I will not bring math into this, but there will be some definitions, and I think it's only appropriate that when you talk about experimentation, any literature that you read will use some terminology of running an experiment. It's only appropriate that we have some variation of what that terminology means. So this is just very, very high level. So let's talk about three things. First of all, let's talk about what is a variant. Very, very simply speaking, a variant is a set of points for which there is a change. So like in continuing our previous example, let's say there is Jill who is within the earshot, hears the piano when Jack is playing the piano, right? So Jill, for example, in this case, could be a user who is part of a variant who happens to be in the room, and the piano is played. So she happens to be the one who hears the piano. Now, control is a set of data points for which nothing has changed, no change, status quo. That's what we call as control. And variant is when we do launch a new version of something, we typically will run it on the audience like Jill, for example. Like that's our variant audience where we are testing that feature. Our control, for example, is Emily, who is not within earshot. She doesn't hear the piano, no change. That's just status quo, right? So Jill may be in the room, Emily may be in the room. Either of them could be in the room, and that's what a randomized control test is. A randomized control test is a test where the variant data points are really randomly chosen. So there is no bias between, choosing Jill or Emily, for example. Either of them could end up in the room. A randomized control test is where you get to control who gets to be in the room. Or maybe another way of saying it is, where is the piano? Is the piano in the room where Jill is, or is the piano in the room where Emily is? That let's say we control the piano, or Jack controls where, Jack controls where the piano is located. That is the test. And the audience is your Jill and Emily. So a randomized control is sometimes it could be with Jill, sometimes it could be with Emily. And then the cause is Jack is playing the piano, and the effect is whether Jill hears it or Emily hears it. A randomized control is that there is no selection bias. Generally, you're trying to select out of a given set of data points, your sample, you're trying to select the data points purely random. That's the goal. You're trying to select them in a very unbiased way and look at what happens on, this set versus that set. Generally speaking, that's what you're trying to do. So in this case, as I said, either Jill or Emily could have been within the earshot of Jack playing the piano. So that's what a randomized control is. Both of them are equally likely. Yeah. So with that, let's talk about some of the challenges. Now, marketplaces are multi-sided networks, right? Usually, there is at least two sides to a marketplace. You can take any marketplace. Talk about Uber. There is a driver. There is a rider. Talk about, same with Lyft. Talk about, Instacart is a North American grocery provider. Shipt is a North American grocery delivery provider. There are three sides to it, right? There's your customers, as I was mentioning before. Your customers placing the order, the retailer where the order is shipped is shopped from, and then the shopper actually going and fulfilling the order. So that there are three sides to it. Think about some other networks. Think about Google AdWords. There are advertisers who are really the demand side, because they are placing ads, and the supply side in this case are the eyeballs, are the consumers, because they want to have the consumers do some action, like fulfill a demand that they are actually looking, either watch a video, click a video, do something, take an action. So there are two sides there as well. So multi-sided networks like marketplaces, the biggest problem with testing in multi-sided networks is that they have something called interference. We'll see an example of this as we go. But really what that means at the high level is when you change demand for a variant, right? We talked about, variants and control. When you change demand for a variant, that can actually affect supply in that variant, which can actually affect supply and control, which can actually affect demand and control. It can actually have a seesaw effect. And that is really what a network interference is. We see this with an example as we go. Because of the seesaw effect, what happens is that the metrics between the two sides, when you're doing an experiment, they basically get inflated or deflated. One goes up more than it should. The other goes down more than it should. Typically, it is 1-to-1, but it doesn't necessarily have to be. It depends on if your distribution is skewed, how you select your audiences, etc., etc. Typically, it is 1-to-1. Like if your sales in one of them are doubling, in the variant are doubling due to a price reduction, maybe in the control, you will see that everybody is going there. You're losing supply because of that. Your books are running out, something like that. And because of that, your sales in the control are now plummeting. So there is some sort of network interference. We see that example as we go. So that is what I mean by, if sales was your metric that you were measuring out of an experiment, you would see sales go up in the variant. But guess what? Indirectly, you are unexpectedly affecting your control where sales are going down. So it's looking artificially inflated more than it normally would be. If you had the same effect everywhere, it would not be a double increase. It would be like somewhere in the middle. But it's difficult to kind of analyze that. It's difficult to, discount for network interference and all of that, like in complex marketplace. It's just very difficult. And we'll see that. That's basically what I said there, especially when you're running many concurrent experiments with many different business lines across many. One user might be sometimes part of 5, 10, 20, 50 experiments. As I said, they don't know. They might be part of many, many different experiments running at the same time. It could be very difficult to analyze the effect of network interference because, in your experiment, the variant actually impacted control, which again went back and impacted variant. And finally, I think the biggest thing is, as with any experimentation, not just marketplace, do not confuse correlation with causation. The question you asked, Gavin, do not confuse correlation with causation. Be very confident that you don't have false positives or false negatives, and you need to have a strong confidence. And there are ways of statistically measuring confidence. You need to have a strong confidence that A actually caused B, and B did not happen just, it happened because A happened. That reverse causality is something good.
So, Vishal, do you think it's very fair to say then that marketplace experimentation, it can be very hard due to the highly fluid and interconnected nature of the marketplace? Effectively, a product marketplace is like its own little economy where it's very easy to either positively or negatively impact supply and demand through the experiments. So it's really something that experimenters need to be highly mindful of and cautious of.
Yeah, I think you summarized it in a very good way. It is like a mini economy in and of itself. Except, in a real world economy, there are so many variables that, and you don't have control over all the variables all the time. Here because you're running a business, it's a closed economy. You have control. And usually when you design an experiment, usually you're trying to affect 1, 2, or 3 variables only at once. Right? You're not trying to affect entire business because your experiment is contained to a certain segment of the population. But you're right. Even when you are very surgical and the experiment is contained, it can actually kind of, one side can impact the other. It is pretty complex. It's pretty complex. You're right. In fact, I would say that a lot of new age experimentation techniques now are coming out of companies like Lyft, Uber, Instacart, all these new real world marketplaces. You can go to their websites and you see, data scientists publish blogs upon blogs about the new ways of running experiments. These techniques have existed, by the way, for a long time, but they were never used in these because the complexity of the marketplaces are so high. You have to actually bring a lot of different techniques into place to actually be able to make a sound, confident business decision. That's absolutely true.
Yeah,
absolutely.
Great point.
Yeah. All right. Now we'll get into the meat of it, the art and science behind experimentation. And let's start by painting a picture let's start with a simple test scenario or toy scenario, and let's go from there. So for the rest of the presentation, I want the audience to imagine that there is a bookseller. We have a bookseller, and the bookseller sells different books from different publishers in roughly, let's say, 100 physical locations in 3 states in the US. So in New York, in California, and in Washington. So they have 100 stores each in New York, in California, Washington. 100 is just a number, but just to keep things equal, in New York, California, and Washington, they have 100 stores. They have 300 stores across these 3 states, and they are selling books. It's a physical location. I specifically chose a offline experiment versus an online. I was hoping that this would become more relatable. You should be able to take the learnings from an offline experiment and actually translate them into an online world. But I just wanted to make a point, even in an offline world, how these kind of techniques, some of the biases, network interference, etc., that we talked about, how that can show up even in an offline world. I wanted to motivate the example because I feel like it will be more relatable with a simple bookseller as an example. So start here, and then we can see how it goes from here. So now for this bookseller, just assume a very simple business model, a very simple framework. Every book that they sell, they sell many books. Every book is sold for $10. Same price for all books. Also, let's assume that throughout the week, they sell about 200,000 books. And just for the sake of explaining, the different techniques a little bit, let's assume that their biggest market is New York, where they sell about 100,000 books out of the 200,000 weekly. And then the other 2 markets, it's 60-40 split. So 60,000 in California, 40,000 in Washington. Very simple model. And generally, because they're selling 10 books, right? $10 per book, and it's 200,000 books, the weekly revenue is $2 million. And a very simple goal. Now, this bookseller, they have a business goal where they want to simply increase their revenue, right? They want to go from 2 million upwards. That's it. Now, this is another word that comes from the parlance of experimentation, which is hypothesis testing. Hypothesis is generally, you have an idea, you have a theory, and you basically want to test that theory through an experiment and validate whether or not that hypothesis is true or false. Really, generally, that's what you're trying to do. And their hypothesis, their guess is that if they reduce the book prices from $10 to something lower, that would increase sales. The number of books that are sold, will go up from 40K, 60K, 100K, from 200K, some upwards. And that would actually increase the revenue. So the drop in price, the rise in sales should offset the drop in price. That's really the second layer behind the hypothesis. The rise in sales should actually offset the drop in price, and it should effectively raise the $2 million to a higher number, over $2 million per week. So far, so good? All right. Very simple. I'm trying to this can get very complex. So let's, hold your horses. Now, here we go. So let's talk about some testing and analysis techniques now. All right. So the very first thing that any business, any company, the way we start is the first thing that they would do in the variant, which is, again, just to remind everybody, is the set of data points where a change was made, and control is the set of data points where no change was made. So in the variant, their variant is they do a time-based test, and this is also called a pre and post. Pre the change and post the change. So what they say is, let's drop the price of the book to $9 on 8th of May, right? So they pick a date. They say that the book prices will be dropped to $9 on 8th of May. We will look at data before and data after, pre and post the price drop. What happens? So the results are versus the control period in the previous week, which is 5/1 to 5/7. And we follow the MMDD system here. So, that's month and date for people who are not familiar with that system. So that's May 1st to May 7th. The sales in Washington are higher in the next week, but between 5/8 to 5, the sales rise in Washington in the following week. So versus the control, versus the previous week, the sales rise in Washington in the next week, 5/8 to 5/14, but they actually fall in California. Now, remember, the hypothesis was if you drop prices, the sales should go up and the revenue should go up. In this case, one of them shows that the sales have gone up. Washington sales have gone up, which is the smallest metro, which is only 40K. But California is the middle metro with 60K, with the middle state with 60K. And there the sales have actually fallen. Why would that happen? Right? Let's talk about that. What can happen? A lot of things can happen. One of the possibilities is that there was some external interference, meaning some bad weather happened in California, right? There was a wildfire, there was a storm, there was flash floods, something like that happened, because of which maybe there was some civil unrest, for example. Something like that happened in the post period, because of which the sales actually dropped in California. That was not the intention. This is something external happened, completely external to the experiment. And we will look at this. This is just to, paint an example of what are the pitfalls in business decision making. Ultimately, that's where we are going with this, right? So this is a pitfall. If you only looked at Washington and if you only tested in one case and you only analyze Washington results, you would say this works and you would just launch that nationwide, which would probably be not a sound business decision because you haven't actually looked at California and New York. In this example, that can happen. So that's clearly not bulletproof, right? So we need something better. Let's just say that. But here's the interesting thing, right? For a business, really, this is the blueprint of how to run a business, right? When you look at the stock market filings, Wall Street filings in the US, your quarterly reports, your annual reports, they will usually report growth metrics, revenue metrics, user metrics, ad revenue, this and that, quarter over quarter, sales, year over year. So again, coming back to what you were saying, Gavin, if you think of the entire business as an experiment, in some sense it is. At that level, at a very high level, when you're dealing with billions of dollars, it is fair to say that, the business is doing better over time because it is a collection of so many small decisions. At that point, it is sound to say that, yes, the business is doing good. Therefore, investors want to invest in it, because they feel that the business is doing better. They have sound strategies, etc. At that level of granularity, at the highest level of granularity, it is fair to measure a business and a business experiment, to measure that using this kind of a technique, using this test. But if you go down, as we saw, right? If you go to Washington, California example that we saw, that's usually not a good launch decision for launching a small feature. For just dropping the price from $10 to $9, that's usually not a good decision. You just haven't looked at all the factors. It doesn't discount for all the external factors. So, the good news here is that it's very easy to analyze and understand. That's the pro, right? Everybody can say my sales last week versus my sales this week. That's very easy to understand for business, for anybody in the company. The problem is it is very difficult to attribute cause and effect. As we saw here, you don't know whether the sales rose or dropped. Now, looking at California, how can you guarantee that sales in Washington did not rise because there was something else that happened in Washington? You cannot guarantee that, right? Because something external could have happened. So it's not very sound, unfortunately. And again, as I was saying, it's not a very scientific way of doing things. So don't make it's a good way of making business decisions for at a higher level, at a very aggregate level. It's not a very scientific way of deciding whether this is the next feature to launch or not. So don't make small optimization or launch or incremental optimization decisions based on it. And that's generally in practice, use that on an aggregate and a directional basis. So that's our test one, right? I'm sure, Gavin, you may have seen, various places. As I said, very relatable, right? You see that in stock market filings or, how businesses are doing over time, etc. That's generally how people, think about like whether a business as an experiment is successful or not.
Yes, I was just reflecting, and pre and post is the most heavily favored form of analyses in business and the most readily used. However, there's never any thought of the upside and downside of using this approach and the nuance involved. So to your point, it's not scientific and difficult to attribute cause and effect.
Not scientific. That's exactly right. All right, let's try something else. Let's actually do this based on geographies, right? I mean, time doesn't work. Clearly, we saw that. So now let's do this. Let's only drop prices in Washington to $9 and everything else stays the same, right? California, New York, no changes there. So now we should be able to see a lift in sales in Washington versus California, right? All other things being equal, we should be able to see a lift in total revenue. You can always normalize it. Obviously, California was selling, just to anchor everybody, California was selling 60,000 books per week. Washington was selling 40,000, and they were making a certain revenue. You can normalize by the number of sales, but you should say that if your hypothesis was true and you dropped the price only in Washington by $9, your price per book or your total sales and your total revenue should actually go up, right? Your total sales should go up. So that's what should happen. Now what we see is, in this example, next week from between May 8th to May 14th, in the following week, now sales rise in both Washington and California. This is not intended. Like California was never a variant. It was controlled essentially, but sales rose there. Now, why would that happen? Right? That's again, like, is this very scientific? Like, how do we make decisions here?
I've just got a quick question on geo-based testing and in reference to marketplace experimentation, that what we've discussed is that randomization of experiments locally to supply and demand side, it can introduce biases in experimentation results and potentially overinflate experimentation findings. From your experience at Shipt and Lyft, did you then find that for a product change or to test a marketing campaign or an algorithm change, that you were then elevating experiments up to the level of city or state and then comparing city or state to try and overcome that localized user bias?
That's a good question. We will cover an actual example of what is a sound technique for running it. So first of all, I would say that running an experiment at a city or a state level is very costly. First of all, right? I mean, this is a very simplistic example, but imagine if this was literally 200,000 was the only revenue that this bookseller was making. Doing it at the state of Washington level is just extremely costly because you're doing it across, all the stores, dropping like across, what. So we said Washington was 40K out of 200K, right? So that's 20% of your entire volume. You're actually dropping it by $1. That can be a very, very costly experiment to run. So you don't try to run off just because you don't observe strong causality in a small city or in a small state. That doesn't mean you go one level up and you start aggregating. It's costly to do it. You do go to some other techniques. You do fall back to other techniques. We will see, and we will also see an example specifically from Lyft to my second point, Gavin, where there is a case study of how Lyft actually tested pricing, prime time, which is surge pricing, and how the network interference actually showed up and what technique did they actually use to get around it. So we'll talk about that. Geo is not that technique, is what I'm alluding to. This is still looks like it's kind of flawed because, as in this example, the sales rose in both the cases. Now, how do you know what was the cause and what was the effect in this case? So we will come back to that. Let's put a pin on that for now. All right. So what could happen here? Well, in California, something like a major book release by some celebrity author in Los Angeles, it's Hollywood. Somebody might have released a big book, some celebrity, and that could have inflated sales in California. Completely external to the experiment again, unfortunately. This, as you said, it is pretty common to test in one metro on one market and compare it with a control market. Typically, it is a technique that is used in marketplaces. So the point that you are making is valid, that it is used and it is easy to understand and analyze as well, right? You can normalize, as we said, not normalize the total revenue by Washington sales and California sales, and you can see what is the apples to apples revenue between California and Washington. It's very easy to understand and analyze. But unfortunately, in a lot of marketplaces, it does not scale from one to all markets, especially in geographical marketplaces, because in a lot of these marketplaces, the effects are very hyperlocal. So what actually works in California or Washington due to various factors, state laws, minimum wages, how you price things, this and that. Usually it's not every book across every state is priced at $10, right? So we have a hypothetical scenario. But even then, what worked in Washington and what worked in California should not and cannot be generally used as a proxy for all states and the entire country. I will give you an example where we had run an experiment in the past, without disclosing too much. We had run an experiment in one of our smaller markets where we actually thought of launching it in nationwide, scaling it nationwide. We saw very good results in one of our smaller markets. That small market was actually this was before my time, but I heard about the experiment. That small market was a very healthy market. It had a very high number of shoppers. It had a very good supply to demand balance ratio. Things were getting claimed really fast. Like the orders were getting claimed because there were enough shoppers, etc. But the average supply to demand ratio, the average claim rate across the nation was not exactly according. Although it was a small market, we went for size. We didn't want to, as I said, we didn't want to cause a big impact. So we went for size and we went for, this healthy market. Unfortunately, the dynamics in the entire marketplace nationwide were not the same as that market. And so when we did that, in that case, what we did was we did launch incrementally. So we started going from one market to the other, and we somewhere caught it in the middle where we figured out that this is not something that is scaling. We did catch it. But, case in point is, if you are a smaller player, like you have only 3 states in this example, you don't have that many things to experiment with in the first place. So how do you actually even do it? This is not the right way. We caught it, but there is always a risk that in these kind of marketplaces, that generally marketplaces which are rooted in the real world, right? Not online marketplaces are different. Online marketplaces, then you talk about things like, because they scale globally. So then you're talking about whether an experiment in the US will scale in China or whether it will scale in the UK. That is a different, it's the same problems apply, more or less. But, it's a little more homogenized. In offline marketplaces or real world marketplaces, there is more heterogeneity, right? There is more hyperlocal effects. So in that case, it is usually what happens is that what translates in a few markets, which are very similar to each other, may not translate to some other markets which don't look like that. That happens a lot, unfortunately. But a lot of companies, for lack of a statistical orientation and experimentation orientation or that mindset, will resort to, let's test in one market because they understand markets. Let's test in one market. Let's go to the other. Let's go to the third one. Unfortunately, again, drawing that causality, right? And being able to say that with confidence that if this happened in Washington, it will also happen in California. If this happened in these two, it will happen nationwide. The biggest of the biggest tech companies, what they will do is there is a strong emphasis on having high confidence in that causality. And once you know once you know with high confidence that Washington works, then you can just literally launch across the entire US without even trying to test it in another market. You can just go for it because you have very strong causality. That's how these companies which have an experimentation mindset, that's how these companies are able to scale that fast. It takes time to build that culture, but once you know, and once you have the confidence in the data, you don't have to think twice. You don't have to look over your shoulder. You did it once. You did it on a small set of data. You know that you weren't biased in picking Washington over California, or this was you didn't actually. There was no like hyperlocal effects. Just to take that as an example, you were confident that when you selected the metros or when you selected the audience, the variant to experiment on, you knew this variant is representative of my entire population, so I can just scale. But this is not that use case. In geo, that's typically not true because hyperlocal effects are very different across states.
Yeah, I find geography quite intriguing. That I've run a lot of experiments here in Australia across the country, and in my experience, I've found that the eastern seaboard, particularly, behaves very similarly across Queensland, New South Wales, Victoria. The west of Australia operates like its own microeconomy, and the remaining states and territories also behave independently and very different to the other states and territories. So making an assumption through an experiment on the eastern seaboard and assuming that consumer behavior will apply a broad brush across the whole country is fundamentally flawed.
It just doesn't work. Thank you for bringing that point, which is exactly the last on this slide. In this example, you would literally have to test this in every single state independently, in which case you're not running a scalable experiment. You're just testing whether something works, and it's scattershot pricing, right? You have some pricing here, you have some other pricing there. It's just all scattershot. It's not experiment driven. Thanks for bringing that point. All right, so we can do better. So let's see. Even with this, we can do something better. Let's say that we did run that test, and it costed us some money. Can we actually salvage some of the data that we got there? Right? Let's start there. There is an analysis technique called difference in differences, or DID. The acronym is DID. What we're trying to really ask here is, can we get the true change in Washington using California as a proxy? Okay, because sales rose in both Washington and California. Can we get to the true change in Washington using California as a proxy? There is an assumption that we will make here. I know the example I gave previously in the previous slide was some celebrity released a book in California, which is an outlier, which I understand. But if you assume, there is a strong assumption, which is assume that California and Washington have similar sales trends. Assume that nothing external had happened. In California, just for a moment, let's assume that without price changes, sales in California and Washington would have changed the same way. If you did not experiment, let's say there is an organic increase in sales for whatever reason in Washington. Let's say it's the National Book Month. Somehow the post launch period falls into the National Book Month. Some event, something like that happens. Or maybe a celebrity author doesn't just release his book in California, his or her book in California. They release it nationwide, so all markets get it, and the sales are elevated across all of the markets in this example. So you would have to assume that they are similar trends, and in that case, if you did assume that, then a different diff model the essence of the model is that you can use California metrics to discount for changes in Washington. Which means that the table at the bottom really just says leads to the insight on the left hand side, which is, if you looked at the difference in sales in California, 40K, 60K, right? That's where we started. So between in the pre-launch, the sales were 40K and 60K. In the post-launch, the sales became 70K and 80K. So there is a rise in both sides, right? 60 goes to 80, 40 goes to 70. But what is the true difference in Washington compared to what was in California? So the different diff really says that you take the difference in California, you discount Washington for that, and then what is remaining is really the true change of your experiment. That is the reason why that was the true change of your variant. That's simply what different diff is you basically take something with a parallel trend assumption, with similar trends assumption, and you actually discount that to find out the true change. Simple enough, right? Simple enough. When you go and look at this in papers, it's pretty confusing because there are a lot of online papers, and the way they try to explain what different diff is. The key insight is, as I said, simple enough. Without any variant in Washington, without changing prices, it would have actually changed California. It would have seen the change that California sees. So just remove that difference from this difference, and then the remaining effect is basically what you would see because of the change that you made. So that's one technique that this is still a technique that is used in marketplaces, especially when you don't have a sophisticated level of experimentation. It's better than nothing. Right? So you have something to fall back on. All right. What are the good things about this, right? You can use this technique, especially when you cannot run randomized control experiments, right? So again, Gavin, the point that you made was that, companies are mini economies. Companies are small economies. But the good thing is people who run the company actually control the entire economy, have control over the entire economy, right? But then there is the real world where nobody has. It is truly random, right? The real world is random. And you don't really have control over all the variables that can change in the real world. And in that instance, when you cannot run an experiment, this technique is very, very heavily used. It's very heavily used to, for example, evaluate the impact of a statewide policy. When one state does something versus the other state, it's not like they are not going to select audiences to implement policy on one segment of the population versus the other. They do it statewide. And using our Washington, California example, assume that instead of that dollar, the book dollars, it was some minimum wage. Let's assume that, for example, right? Then you would actually have to fall back on something like this to be able to say what was the effect of changing minimum wages, due to a policy change, because you cannot really run a randomized control where you can say half of the population gets a different minimum wage versus the other. You can't do that. It's not a closed economy. It's in the real world. The problem here is in marketplaces and controlled economies, similar trends are rare. You shouldn't assume that everything. I mean, even in our example, we saw that, something external could have happened, which would have thrown California sales off. It's not very common. Similar trends are rare. So usually you should use this in conjunction with other testing techniques. It's an analysis technique. It's not a test technique. It's an analysis technique. So you use geo, you use time-based, you use pre-post, you use some other techniques that we will see coming forward. And then you use this as sort of like parsing out some of the unwanted effects or some of the external biases that would have happened without you doing anything to the marketplace in the first place. In fact, the thing that I mentioned, here are couple of case studies. They are actually hyperlinks. For the audience members, we'll share the deck and you're welcome to go and click on that. As you said, the deck will be shared. They can go and click the links. But one of them was exactly that, which was what was the impact of minimum wage on change on employment rate in a couple of states in the US. There's a famous study. That study is actually cited that's from Wikipedia. It's actually cited. It's a study from 1990s. It's cited as a famous study for highlighting how difference was actually used. In fact, the study comes from the 1800s. That the first bullet there was the impact of there was a change in water providers, change in companies, and that actually led to cholera outbreak. So this is what that study really shows in London. That was in London. What that study shows is without that change, how much would have cholera spread anyway, which is the same idea. With that change, then what was the impact of bringing that variant, bringing that new company? With that change, what was the incremental effect, or what was the alleviation that company did? Either added or took away from cholera. There were 3 companies actually in that study. So that was the technique of using diff and diff, which was unchanged. This was how much cholera progressed anyway. With these companies, this is how it actually impacted the rate of cholera. It was first formed in the 1800s, and it's, as I said, we are learning things which are over a century old at this point, and marketplaces are starting to use these things now.
Yeah, I've read that study. It's very interesting that it completely flipped the thinking around cholera outbreak in London from being a virus that was airborne to waterborne. So a great piece of scientific analysis.
That's all from this episode of Experimentation Masters. Just one more thing before we say goodbye. We can use your help to keep improving the show. If you have any feedback or suggestions for future episodes, you can email at gavin@firstprinciples.ventures. Visit firstprinciples.ventures for show notes, resources, and information. If you enjoyed this show, give us a share on social media. Make sure that you subscribe so that you don't miss an episode. Experimentation Masters. Lead with more confidence.